Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, and it's April 24th. Hope you guys having a great morning so far here. We do got a number of data to go over. We'll start off with the Case-Shiller Home Price Index for the month of February. Back in January, it was up 6.1%. And it increased, so showing further acceleration in appreciation levels to 6.3% in February. So great overall numbers there. And this is on the national level. So they do a 20 city index of the largest markets in the U.S., but this is the national level here. Consumer confidence index for the month of April. So consumers feeling fantastic when you see 127, anything above 100. Especially over 100, it should be awesome. These are like all-time highs here. We had 127 last month, and forecast was supposed to dip down a little bit to 125.9, and it exceeded that. It went actually upwards to 128.7. So fantastic numbers there. New home sales for the month of March. We've been having this inventory level issue, and new home sales is kind of helping us out. As you can see here, we had February went up 667. This was actually revised at a much higher. It went up a lot more. And we had a 630,000 forecast, and instead of coming down, it went up to 694. So 694,000 units per annual is what they're estimating for new home sales. So fantastic numbers here, what we're seeing, which is great news. So economic calendar was full of bright spots right here. But the market's down. So why is the stock market down? Well, it's not too much by the earnings reports. So earnings reports, for the most part, most of them are reporting great news. Some of them are just meeting expectations, or some of them are even shortening their year forecast. So some of those things are coming up, and of course those companies are being are down for the day, and or some of them just aren't exceeding it that much more. So sometimes if you're just meeting expectations, it's not quite good enough in this particular climate right now. But the biggest thing right now is the concerns over the U.S., like we talked about yesterday. Concerns, we're touching the 3% range right now. And the concern about that is, of course, these corporations have cost of doing business is getting these loans. And with their rising costs going up, it could help stunt or growth of what these businesses are going. So this could, damper things in the near future. Uh, some forecasts are showing that maybe sometimes later this year or perhaps next year we could go into a recession, a technical recession. So again, we'll have to kind of wait and see. A lot of things are going good right now, and at some point, yeah, I mean, with the Fed kind of raising rates, trying to slow things down a little bit, it might slow it down enough where we could, it could slow down enough. When they raise rates, also, it takes about a good 6 months until the economy absorbs that and kind of goes into the absorbs it, and kind of it takes the effects kind of take place here. That's what I was trying to say. Sorry about that. So let's take a look here at the bond market. Bond market, as you see, is continuing this downward trend right here. It broke down below the second level of resistance, or floor of support, which has been a really strong support. And it's not looking good. We even went down to the furthest one, even touched off that earlier this morning and pulled back a little bit. Currently, we're down about 12 basis points from where we left off yesterday, which is enough to say worse pricing today. We got pricing's not as good today. So lenders will come out with a little higher interest rates today as a result of that. So as we talked about the 10-year Treasury, we did touch here at the 3% range here. We're currently sitting about 2.99% range. Now, one guy here, Barry Habib, he's been on a few of the news outlets out there, and he thinks, he was kind of projecting for a while that we would hit the 3% range here, but he also thinks the first time we hit it, it might hold and then for temporarily, and then eventually it'll kind of break above there. And a lot of that has to do with the lack of demand for mortgage-backed securities and treasuries, primarily because you have the Federal Reserve trying to reduce their balance sheets, and with stocks is hot, people are putting more money into equities, and then global yields. Even though we have really high yields, the dollar's relatively weak, and they would lose money with the currency exchange just to buy our treasuries, even though our treasuries are much higher, our yields are much higher than other countries. But the global yields are also rising a bit as we go go forward as well. So just stay tuned here. We'll have to see how this plays out, but this is pushing mortgage-backed securities further down, which is raising interest rates as a result. So just be out there cautious, and hopefully, if you guys are in any transactions, hopefully you guys are locking in as we speak, because again, it could get a little worse than hope. So that pretty much wraps it up for the day. If you guys want anything else, just come over to Twitter. You can find me there. I do post data throughout the day there, and you might find some interesting stuff, including the close of the markets and stuff. So just come over to Twitter. You can find me on my handle at Mike Bjork. Otherwise, enjoy the rest of your day. I'll look forward to see you guys tomorrow. Thanks so much for watching. Bye-bye.